So we're absolutely honored to have John Neff and Chris Cerrone here with us today. John Neff is a partner at Akre Capital Management and a service portfolio manager since August 2014. Prior to joining Akre Capital Management in 2009, he worked for 10 years at William Blair and Company in the firm's equity research department and for 7 years as a senior analyst. Mr. Neff worked at First Chicago NBD Corporation from 1996 to 1999, after beginning his career in the securities industry at Merrill Lynch in 1994. Chris Cerrone is a partner at Akre Capital Management and a service portfolio manager since January 2020. Prior to joining Akre Capital Management in 2012, Mr. Cerrone served as an equity research analyst for Goldman Sachs and Company in New York from 2010 to 2012. In that position, he covered restaurant and retail companies. He began his investment management career in 2007 as a junior equity research analyst with Century Capital Management in Boston. Thank you for joining us today.
Thank you, Itai.
So our first question is, if you could begin by please describing your investment philosophies.
Sure. So at Akre Capital, we are proponents of what we've always described as the three-legged stool. So what it is that we're trying to do is we're looking for great businesses, which we typically think of in terms of durable competitive advantage, run by great people, and that have great opportunities to reinvest all the great free cash flow that the business generates at high internal rates of return and thereby compound. So those are the three legs: great business, great people, great reinvestment. When we find those things working together in concert, we sometimes call that business a compounding machine. And then our objective, once we've identified these businesses, which by definition are very rare, what we then try to do is not pay too much for them, so that our experience as investors is commensurate with the kind of returns that the business is generating. And so the results of that approach necessarily results in a low number of names that meet our criteria, so we're very highly concentrated, and our turnover, meaning how frequently the names in the portfolio change, tends to be extremely low because we tend to hold on to these businesses for a long, long time.
Yeah, that makes a lot of sense. Thank you for that. And can you discuss why you're more attracted to these long-term compounders rather than trying to find 50 cents a dollar bills?
So just to back up, I think the question is really asking it for a comparison between what is traditionally referred to as value investing and what I think has become referred to more as quality or compounding investing, which has become a lot more popular over the last few years. And so in the traditional value investing approach, a manager buys a stock at a fraction of what he or she believes is sort of the intrinsic value, owns that stock until it approaches the intrinsic value, sells it, and then tries to redeploy that capital in other businesses that are trading below that intrinsic value. And that's what we sometimes refer to as a 50-cent dollar bill. You're buying something that's worth $1 for 50 cents and then rinse and repeating. And so it's a perfectly reasonable approach to managing money. And some of the greatest investors that have come before us have done it just that way. There are certain disadvantages associated with that approach. The most, I think, problematic from our point of view is the component of that strategy where you're constantly having to redeploy the capital in new ideas. You have a finite life. You have to sell. Often, if you're a taxable investor, you're realizing a gain and paying a portion of your gains as capital gains taxes, redeploying and going over and over again. So it ends up being a very decision intensive process. You're having to make a lot of buy decisions, a lot of sell decisions, and there are a lot of transactions involved. The attraction to owning long-term compounders, by contrast, is that you're making much fewer decisions. You're hopefully, if you're doing the work right at the beginning, you're buying an exceptional business once that you think can compound for decades potentially, and there aren't any redeployment decisions, there aren't any taxes, and so the challenge becomes in an environment like this is where a lot of people are thinking in those terms, is staying disciplined and making sure that you're paying reasonable valuations. But that's a high level comparison of value and quality investing.
Yeah, absolutely. Thank you. That comparison is very helpful. And were you always attracted to the compounder philosophy from the beginning of your investment career, or was that something that sort of evolved over time for you?
I think, I won't speak for John, but I think that we were both just congenially attracted to that approach. And there's having a hard time getting my screen to stay propped up here. There we go. So there's this great line by John Train. He says, develop a congenial investment strategy and stick to it. So in other words, do what works for you, do what you're attracted to, do what resonates. And so for John and I, that's finding these quality businesses. Chuck Akre, who founded our firm, describes, and you can find it online in a couple of videos on YouTube or elsewhere, how he went on his own investment journey at the very beginning as an English major and said, what works and how do you generate above average returns over long periods of time? And that's ultimately what led him to this approach. And John and I are what we call true believers, and we wholeheartedly pursue this approach.
Yeah, that's very helpful. Thank you for that commentary. And how do you find yourselves generating stock ideas?
Well, we read a lot, and I sometimes describe the process as pulling on strings. And most of the time, you're pulling on a string, and the string will break. In other words, the idea will not sustain further consideration beyond a certain point. When you're investing the way we do, the premium that gets placed is not on the quantity of ideas that you're vetting, but the quality of those ideas. And we have very clear and very high hurdles for what gets into our portfolio. And when things don't measure up, efficiency is really sort of measured by how quickly we can come to that decision. So most of our strings in terms of new ideas tend to break off at some point. And once in a rare while, the string continues to hold, and now it becomes sort of fishing, and you're sort of reeling on this idea, and the string continues to hold. There continues to be an idea at the end of this line. That's rare and that's exciting. And then what we try to then do, once we think we may in fact have something, we tend to go through what I call the valley of despair, which is you take this rare idea that we have for something that actually might deserve to be under serious consideration, and you try your very, very best to sort of disprove your enthusiasm and to try to poke holes in it, to try to figure out why, in fact, it's not as good as your initial reaction would suggest. And then if in fact the idea comes and survives that valley of despair, then it's incumbent on us as analysts to really make sure that everybody understands the value of this idea. And hopefully what we can try to do then, it's on us to create a shared understanding and hopefully a shared conviction as to why that idea should be in the portfolio, either now or at a future date, valuation allowing.
And as part of that process of vetting an investment, how critical do you think it is to speak with management? And if it's fairly critical, what type of questions do you usually find yourselves asking them?
Well, it's a great question. We talk about the three legs. So the three legs are the quality of the business, the quality of the reinvestment. That's the third leg. And there's typically a track record associated with those two. So the second leg of the stool, which is the management team, it's our understanding of that management team and its quality, its caliber is typically iterative. So it takes place over a long period of time. One of the things that we're very interested in asking managements and trying to understand from management teams is that reinvestment aspect of the business, because typically we're looking at businesses that generate abundant free cash flow, and how they deploy it and how they think about deploying that free cash flow as a management team is critical to setting the stage for the rate at which we can compound in that business as an investor. So understanding how they think about reinvestment through the P&L, reinvestment in terms of capital additions, how do they think about dividends, how do they think about acquisitions? These are the things that are going to sort of, hopefully, they are rank ordering those reinvestment choices in such a way that we feel confident that this management team has a compounding mentality and understands the building blocks that are going to get us there.
Do you sort of hold in higher focus seeing what management does during, let's say, financial crises, like when the stock price is depressed, if they're focusing more on buybacks, if they have ample liquidity, or do you specifically focus on sort of those recession periods where the company is struggling, to see what management does then compared to when business is going better?
It can certainly be very revealing. The reality is that few businesses, even among really, really good ones, tend to behave in an optimal way, at least with hindsight, in the depths of a financial crisis, because cash preservation, capital preservation becomes very important to people. Periodically, you'll find companies that have behaved incredibly well and really sort of taken advantage of these crises to lean into those reinvestment decisions and come out the other side in an even stronger way. And that absolutely separates the men from the boys, so to speak, in terms of great manager decision making.
Yeah, absolutely. That's very helpful. Thank you for that. And from what I've seen sort of from the portfolio, it looks like you have a lot more of a focus on companies that are incorporated domestically than ones that are more international. Can you describe sort of your reasoning behind that?
Sure. So it's an accurate observation, although I think the key there is these are businesses that happen to be domiciled in the United States. Most of them are very active in markets outside of the United States, and I think that's a reality of most businesses today. As a mandate, our fund is actually so we live by a certain set of rules in managing the Akre Focus Fund. Some of those rules are put upon us by the regulators. Some of those rules we self-select, and we describe those to our investors in a prospectus. And the purpose of that document is to give investors a very clear idea of what they can expect from us as investors. And so in our prospectus, for example, you'll see that no more than 15% of our fund's assets can be invested in businesses that are domiciled outside of the United States. And so that is a part of the reason why it's a mostly US-based fund. But again, if you take businesses like MasterCard and Visa, American Tower, software companies like Adobe and Salesforce, I mean, those are global businesses selling to customers in the vast majority of countries. And so I think it's important to have that global mindset, but there are some real advantages to investing in businesses that are based in the United States. There's a rule of law, to expect from that, property rights and very efficient, liquid functioning markets. So those are all advantages.
Yeah, that makes a lot of sense. Thank you for that. And then overall, compared to in the past, do you believe that it is getting easier for companies to maintain their moats as a result of global scale, or harder for companies to maintain their moats because of the rapid pace of technological change?
I guess it's hard for me to say. It does seem to be harder, but one of the things that is critical to our process, I don't know any hard and fast rules. I mean, it is interesting if you go back and sort of looked at the index composition of the S&P 500 every 10 years. It could be interesting to see the rate of change in the components of that index, kind of measured by decades. That could be an interesting sort of corroboration one way or the other. But one of the things that's critical to our process is that our understanding of a competitive advantage is invariably qualitative understanding. And so we are not investing on the basis of things that you can screen for. So the extent to which technology is being kept abreast of in a critically important way in terms of competitive advantage, we're not going to be in a great position to make that call. And so what we're trying to do is limit our investment into companies where we have a qualitative understanding of why this business wins today, why it's won in the past, and why we think it's going to continue to win in the future. If the answer is technology, then we're unlikely to invest on the basis of that. Not that technology cannot change competitive advantage, it certainly can, but we're certainly not going to invest on the basis of thinking that we have a better insight into that aspect of a business than anybody else.
I don't think that we could probably make any grand pronouncement that it's harder or easier today than it ever has been before in terms of moats. I've certainly heard the argument that the availability of capital and the availability of distribution through the internet makes it easier than ever to start new businesses. And I think in particular, people are talking about digital businesses, internet businesses. On the other hand, we see businesses that are so that theoretically should mean that it's harder to defend your moat. But on the other hand, I think as businesses grow, there are new types of network effects that really become harder and harder to displace. And so, it's a toss up. I think it's a wash. At the end of the day, whether you were investing in 1975 or you're investing in 2021, I think the recipe is the same. It's finding good businesses. And the way you do that is through those qualitative insights that John was talking about and paying reasonable multiples for them. And that's sort of the approach. And looking at them individually. I think it's hard to make big generalizations.
Yeah, absolutely. Thank you. That's very helpful. And what are your tips for analysts when they need to analyze stocks when there might only be a short period when their price is depressed, such as what happened during the flash crash?
I think the key to managing crises, particularly when, one of the things I think kept a lot of people on this from putting more cash to work than did. If you go back to February to March of 2020, was an expectation. Well, bear markets just aren't this short, and so, in other words, there was a sort of a time component to their approach to managing that crisis. And the approach that we took wasn't a time-based approach. We put a lot of cash to work in that month period, and more as March progressed of last year. And the reason why we were able to do that was not because we said, well, bear markets last X amount of months or years, but we understand, we always have a sharp pencil on what we want to pay for the businesses that we own or want to own. And when prices are dramatically above that level, we simply aren't interested in putting cash to work. So when they are below that level, we get real interested. And the reality, the short reality was we had a lot of things that were hitting and even dipping appreciably below our buy targets in March of 2020. And so it just came down to having cash, knowing your businesses, and knowing what you want to pay for them, rather than anything else.
And that makes sense. Thank you for that. And then is there any sort of difficulties where the investors in a fund might sort of be thinking backwards when the market gets very depressed, they want to pull money out because they get frightened. And then when the market is in sort of overdrive territory, they want to put more money in where there might be limited opportunities to deploy that. How do you sort of mitigate that effect, which can sort of have a drag on funds?
Well, I would say two things. The first is, I think it's helpful to think about money you have invested in the market as 3 or 5 year money at a minimum. So you don't have any near-term design on anything that you have invested there. And so losing a little bit doesn't hurt so much when you're looking out that far. And then, I don't think it's sort of the classic refrain, which, Warren Buffett has repeated over and over again, which is be greedy when others are fearful and fearful when others are greedy. You can read in The Intelligent Investor, Ben Graham's Mr. Market. And I think that's just a great way to constantly bring yourself back and say, okay, what is the environment we're in right now? What does it feel like to me? And you can look around, you can look on CNBC, you can look at the Wall Street Journal, you can go on Reddit probably now, and you can get a pretty clear idea of what the sentiment is. And if you see fear, then, be bold. And if you see a lot of greed and enthusiasm and folks not asking questions and thinking more about what could happen potentially, then maybe be more cautious. And I think if you keep doing that, then I think you'll do all right.
But as sort of like a fund manager, I think what I was sort of referring to more is like if your clients are sort of, thinking the opposite way of how, they're trusting Mr. Market too much. And obviously you're trying to you're being more contrarian. How do you sort of convince your clients to think more contrarian as well?
Well, I think
Devin,
it's a great question, and you've spoken to Devin Ramirez, who is primarily responsible for interacting with our institutional investors, and I think that what you're talking about is an issue of mutual funds writ large, because what we're operating in a mutual fund is a daily liquidity vehicle. And we have to be able to meet redemptions when and however large they are and whenever they would happen. And you're absolutely right that this can be investors can be their own worst enemy and want their money back at precisely the wrong time. We've been very fortunate heretofore in terms of having an investor base that actually does the opposite of that for the most part. That's really been our experience. We had record inflows, I believe, into the fund in April of 2020, following that sharp decline, and that's probably not the industry experience. We give Devin a lot of credit for making sure that our investors understand how we're thinking about the opportunity set, and then going against that grain that too often works against investors' best interests in terms of pulling money out at precisely the wrong time. But it's an endemic shortcoming of the mutual fund industry, that you are essentially borrowing short term and trying to invest long term. So it's in our interest to try to have investors who are well aligned with what it is we're doing and understand what we're doing. And that's the only way we know to mitigate that risk.
Yeah, that's very helpful. Thank you for describing that. And how do you think about inflation today and how it's going to sort of affect investing in the future? Does that play sort of a role within your investing decisions and with interest rates as well?
So we wouldn't have an opinion about most macro factors as far as an explicit projection goes. So that's that, there are sort of two approaches. There's the top-down approach where you start with a macro idea and you look for ways, whether you start at a sector level or an economy level, and then you make individual investment decisions that way, or you can start from the bottom up and pick individual stocks, and that's where we land. And so we're not thinking about inflation or unemployment, industrial production, GDP growth, anything like that from a forecasting point of view. But of course, we have to be cognizant of what all of those factors may do to the individual businesses in which we invest. And so two comments. One would be, I think by and large, we have a portfolio of businesses that are really well protected against inflation, and for different reasons. Certain businesses have contractual escalators that adjust pricing based on inflation. Some are denominated in the currency. So as the currency devalues and more dollars are required to go through, it directly translates into more revenue. And so that's nice inflation protection. The second comment would be, it is true, I believe, that the market discount rate is an outcome with inflation, and interest rates is an important input. It's an output, and those are the inputs. And so it's hard not to see how the market multiple would decline if interest rates were to rise. And interest rates would probably rise if inflation were to rise and stay elevated. And so I think that's what you see on days like today, and periodically over the last few months as inflation fears build up, some of the multiples are coming in. And so we're cognizant of that, but we don't have any explicit views.
Yeah, absolutely. Thank you for that. That's very helpful. And what are some permanent changes that you see in the economy as resulting from this pandemic?
Yeah, I think permanent changes. Permanent's a long time. I sometimes say, how much did the world change in response to the 1918 Spanish flu? I'm sure there are residual impacts from that event, but that event was roughly an order of magnitude more devastating than COVID, and yet I think people today would be hard pressed to say, well, such and such changed because of the 1918 Spanish flu outbreak. So it's obviously very much present in all of our minds, and so permanent becomes kind of a strange word. But that said, I do think that there have been some material accelerations. I think clearly the amount of e-commerce as a percentage of overall commerce by most accounts has been advanced or accelerated by sort of 3 to 5 years, depending on some of the numbers that you look at. That would have happened eventually, but I think that's been certainly accelerated by the pandemic. I think that the ability for maybe the acceptance on the part of employers for their employees to at least have the flexibility to toggle between working in an office and working from home. I think that acceptance for at least the foreseeable is likely to be higher, and certainly we've all built that capacity into our workplaces. But what I guess I really hope the lasting effect or the lasting change from COVID is global preparedness for the next one. I think we were caught much less well prepared than I think and hope we will be next time.
Yeah, absolutely. And then just two questions about that specifically. The first is, Mr. Cerrone, do you think that restaurants will end up going back to sort of a similar split between food delivery and between in-person dining as they had before, or do you think that's permanently been impacted?
So I'm assuming you asked me the restaurant question because of my background.
Yes, exactly.
I have to tell you, it's been a long time since I've spent much time thinking about restaurant businesses. It is how I started a long time ago. There are some examples of some really competitively advantaged restaurants that have done well over time, but they are most definitely the exception, not the rule. So it's not an area I spend a lot of time. So I don't have a great answer for you in terms of how things will evolve from a delivery versus in-person dining. I do think people are resilient and they're also social inherently. And so I would be skeptical of an investment thesis that was heavily reliant on the idea that people would not still want to meet in dining establishments to socialize. Now, that doesn't mean we haven't all had our eyes open to the convenience of delivery now, and that there'll be a permanent shift in consumer behavior as it relates to some of the delivery options. That may be here to stay. I don't think they're mutually exclusive, but I wouldn't think that en masse people are going to stop socializing over meals.
We live in the country here. I don't get anything delivered. I can't.
Yeah, I lived in a rural area as well. So yeah, I have that same experience. And then how about corporate travel? Do you think that's sort of going to bounce back to where it was before? Do you think that will continue to be not as depressed as now, but still depressed relative to sort of pre-COVID levels?
Well, I certainly think personal travel rebounds faster and sooner. I think we see that. And I think business travel will also, but on a slower basis. I think people, again, I think there's a wider acceptance for mediums of exchange, such as we're doing today, that this qualifies as a meeting and feels in person today. Whether that is still the case 2, 3, 4 years out is harder to say. I think this notion of everybody working from home, I do believe as a corporation, it's hard to build or sustain a culture with everybody working remotely. And I think there will eventually be a need and a desire for people to get out and see their customers and their clients and to see each other and have exchanges over the water cooler and in person and over lunch and all those things. I think we'll go back to that.
And has that been sort of Akre Capital's sort of policy? They've been trying to bring back pretty much all of their workers back into the office?
Well, we have. I think we're getting to a point now that we'd like to have. We've been very encouraging of people working from home. We established everybody's ability to work from home seamlessly. We've all taken advantage of that to varying extents, but I think that to the extent the danger subsides and people are vaccinated, that then the impetus for doing that obviously gets removed, and it would be good to get back in the office. But I do think having that ability and that understanding at an employer level that people can be productive working from home, that they don't have to be in the office to be productive. I think hopefully that will be one that stays and gives people better quality of life through better work flexibility.
Yeah, that makes a lot of sense. Thank you for that framework. And so what's your advice for student investors? Where should they sort of be looking? Should they be really trying to focus on relatively very small cap, obscure sort of international companies or other areas? What are your thoughts on that?
So there's a piece that I wrote earlier this year, and it's posted on our website. It's called Advice for Aspiring Investors. And the reason I wrote that piece was we get this question a lot. And I figured it would be worthwhile to write it once, and then everyone can read it, and I don't have to go. There's quite a lot in there as far as steps that that your audience could take, I think that would maybe be helpful. Maybe not all of it's applicable, but some of it might be. And then as far as, I think it's less important, the way that you asked me the question was, which specific types of businesses should they necessarily be focused on? And actually, Devin just said it's the Akre Capital website as opposed to the Akre Fund website. So if you go to akrecapital.com, you look at people, you click on my profile, there should be a link in there. So a couple of the things that I would highlight. One is, I think it is really important if there's an investing club. I think that's who we're talking to. So you've done one thing right already by finding your way to the investing club. I think managing a portfolio of your own, whether it's real money or paper portfolio, is really important. It demonstrates an interest in a way that taking a finance class doesn't quite do. And it's not enough, in my opinion, to just have that portfolio. I think what you want to do is, when you buy a stock, write down why. When you sell a stock, write down why. Keep track of how you've done over time. Be introspective about the process. Hold yourself accountable. You don't have to beat yourself up when you make mistakes, but try to draw some meaningful lesson from them. I think those are all really important. Reading is critical. There are reading lists everywhere. But I think the quality of the investing education is somewhat dependent on the quality of the books you choose to read. So it does matter which books you choose. I think the last thing I would say, and this is probably one of the hardest things to do, is have mentors and cultivate mentors. And you don't have to answer all the questions from experience on your own. You can definitely lean on other people who've been there before you. So anyway, that's what I would say on that.
I would say that, the audience being undergraduates at Brown, what I would also just point out is that I too was an English major as an undergrad. And perhaps because of that, but from that perspective, I also am one of those who would strongly encourage you to choose a major that is going to be of great interest to you intellectually without necessarily a vocational view towards it. My own personal view is, as an undergraduate, get educated, not trained. And so therefore, it's great to major in economics, but to me, economics is not going to necessarily be a great foundation for being an investor. It can be a perfectly fine one, but all I'm saying is, being a philosophy major, history major, chemistry major, learning how to think critically is the most important thing, and combining that with, as Chris said, demonstrable interest in the investing process, I think, is really critical. And the last thing I would say is that I think that we are all wired to be investors of different types. And as Chris said, we are true believers in what it is that we practice, but that doesn't mean that it's the only way to be a successful investor. And I think it's helpful for people to try to really think about what learning curves most beckon to them, and to pursue that and give that real weight in thinking about what kind of investor they are, and therefore what kind of investment approach they can best practice sustainably.
Yeah, that's very interesting. And also your interdisciplinary approach, I think that's something that's really important as well. Are there any books for either of you, either within the investment field, or I know there's ones outside, like in psychology and different disciplines, that they would sort of recommend? What are some of those they would recommend to our listeners today?
Well, to just build on what John was just talking about in terms of that intellectual curiosity and learning how to learn, I think you could start with something like Surely You're Joking, Mr. Feynman, by physicist and Nobel laureate Richard Feynman. It's about being curious and learning. The Art of Learning by Josh Waitzkin, same thing. That'll put you in the right mindset, the right mood. And then there's so many, I mean, I would stay away from some of the really practical investing books to start with. So for instance, if you were to read those two and then you read Business Adventures by John Brooks, which is history of market and some of what happens in the market behavior. I think those are all great. And then of course you can go to the Intelligent Investor, the Money Masters of our time, Common Stocks, Uncommon Profits, all those things those come in time. Just start high and then drill down. I think that's a good approach.
That's a great list. I would say book I really enjoyed recently was The Psychology of Money by Morgan Housel. Again, sort of a great sort of attitudinal and behavioral book. And I love Tap Dancing to Work by Carol Loomis. Great series of articles she's written about Warren Buffett, with whom she's collaborated closely. You know, I just think any book that just gives you insight into the world, that satisfies curiosity. I actually tend to read a lot of, not just nonfiction, but I tend to read a lot of fiction. So just keeping your brain sharp, and always being interested in learning new things. It's amazing the kinds of insights you can glean from casting a wide net.
Yeah, thank you for that. We really appreciate it. And as a concluding question, what qualities, background, and experiences are you looking for in college students who dream of one day interning at Akre Capital Management?
So I would say I would start by saying that the qualities of the people that I think we really enjoy working with are folks who are curious, are passionate, have high degrees of humility. It's really important in this business to keep everything in its proper place. You know, we're making a lot of projections. We're making judgments about people, judgments about businesses. We're not going to get them right all the time. It's really important to have the right mindset going into making some of those judgment calls. But it's really important. So when you're an intern, and when you're a junior analyst, when you're the most junior person on your team, there's no substitute for just work ethic. You just have to be willing to crank through. Everyone's been there before you. It's sort of the rite of passage. We happen to really appreciate what they call a 2+2 background. That's folks who were investment bankers for a couple of years and then were private equity associates for a couple of years. The investment banking is great because we know that it instills a good work ethic. Being in an investment bank, you will see the way that the financial centers of the world operate, for better and for worse. It's equally important to see both. And then as a private equity associate, you get closer to businesses and you get to start understanding in minute detail the drivers of businesses. You'll be working in Excel models that are far more detailed than anything you would ever encounter as a public markets investor, which is useful. You might be poring over legal documents until all hours of the morning for deals. I mean, not stuff that John and I would ever want to do now, but when we hire people, we do like it that they've been there and done that. And then we are welcome to this relative paradise of investing in public companies, and they're well prepared for it.
Yeah, I think I would just add that it sort of dovetails with what Chris said, dovetails with our approach, which is even though we are investing in public equities, we take a private market approach to those investments. In other words, so much of the investment world is fixated on the game of investing, which revolves around daily changes in behavior, reacting to headlines, reacting to macro events, sort of beating the quarter by a penny or missing by a penny. And the approach that we take, so for example, and sort of the quintessential sort of differentiating metric is that we don't consider volatility risk. And in public equity investing, volatility is very often sort of used as a proxy for risk. And my response to that has always been, well, then by definition, private equity investing is risk-free, right? Because there's no volatility. You don't have constantly changing stock prices for the businesses in these private equity portfolios. Therefore, it must be risk-free. And of course, we know that's not true. Of course, we know that, in fact, those businesses tend to be more extended in terms of leverage than they are in the public equity domain. So that's just absolutely not the case. So instead, as a private equity investor, what do you care about? Do you care about volatility when you're assessing risk? No. You care about the quality of the business, the quality of the people you're investing behind, and the reinvestment opportunity and acumen. Volatility is not on the table as a consideration. And that's the approach that we take. We just do it in the public equity market.
Yeah, absolutely. Thank you so much for taking the time out of your busy schedules to join us today. We really, really appreciate it. And this has been a very helpful and educational session.
Terrific. Thank you so much for having us. Good luck.
Thank you so much. Have a great day. Bye-bye.
Bye-bye.